Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to talk about real estate. We'll talk about some other things that are happening in the markets that I think are different than, we'll say, previous times in history. It's some of these things we haven't really seen them before. We've never shut down an economy for 2 months for anything that I can think of, at least not in recent history within the 50, 60, 70, 80 years or whatever. And there's some other things that are happening, like as large of stimulus checks that were sent out. I don't think we've ever done anything like that before in history. So there's some things I want to talk about, some things that I want to cover with real estate and the markets going on. We're seeing some pretty crazy things going on, and I'm going to show you what those crazy things are at the end of this video. We'll get into some charts that just are absolutely crazy. So let's dive in. I want to give you a little bit of my information here, or my opinion, I should say, my opinion. What I have here is the average sales price for new houses sold in the United States. And what we did here is we basically have a long-term trend. We've broken out of that trend. We're doing kind of like a retest to this move. The demographics do support higher house prices, but we had this shutdown. We had a gigantic sum of money get released into the system through stimulus. And previous years, in the 70s, all the way to 80, all these years back here, we didn't have this large stimulus boost, so to speak, an artificial injection of money. That artificial injection of money is going to increase the inflation rates higher than what it normally would under a normal business cycle or real estate cycle coming through. So what could be happening is that stimulus is pushing interest rates higher than what the housing market can tolerate in this short period of time. So we could see a slowdown in housing when the stimulus money comes through, with the interest rates going up as high as they are with the accompanying stimulus inflation. We've seen this in the average sales price of new houses sold in the United States. We're starting to come back down. We do have a couple of months where it's pulled back quite a bit. Now, one could, and maybe I'll do it here just for the heck of it. I'll save this. Let me pull up Paint just to give you an easy line here. So let me drag it over. Here's Paint. And if I were to just kind of drag a line through here, I'll just connect it here. And we kind of drag a line through this and connect these tops here. Basically what we did is we gapped out of this trend line. And we're pulling on back, and as you know, in technical analysis, and I know this isn't, I don't do tons of technical analysis on average sales price for new houses, but we've broken through that trend. We've pulled on back, and we're doing kind of a retest type move, perhaps in the average sales price of new houses. Now, if interest rates continue to go higher, I suspect that this would continue to go lower as the affordability gets impacted. Now, the natural tendencies of the market based off of other real estate cycles, there would be a balance between the buyers and sellers and interest rates, which is the supply and demand of money. But when I got to thinking about this deeper, what's really happening is we've got this injection of stimulus money, which could and probably will push interest rates to a level that the normal business cycle wouldn't necessarily push them to. So interest rates could go a little bit too far to the upside too quickly, given the stimulus that's coming to the system from all of the money that's been injected from stimulus. So perhaps we're pulling back because we do have a good demographic, but perhaps that stimulus money is pushing interest rates too fast, too far for the housing market to take it. Now, the housing market, we're just looking at average sales price of new houses. the new houses sold, has pulled back. When you look at the median sales price of houses sold for the United States, that is still going higher. So it's being impacted first at the average sales price for new houses, but it has not impacted the median sales price for houses sold. So that is still going higher. House prices have not crashed. And I don't want to hear people, he thinks the house prices are going to crash. I do not think that house prices are going to crash at this time. We are continuing to go higher on a year-over-year basis. I've got a lot more data to show you that. But there's the possibility that the stimulus money puts interest rates at an unaffordable region for the pricing of housing at this short period of time. Because the interest rates are usually governed by the inflation in the system through the loaning process. This inflation coming into the system isn't coming from the loaning process. It's coming from another source, stimulus. Now, when looking at the new privately owned housing unit permits, the permits are very high still. They're at 1.7 million, 1.674 million is what the housing permits are at. The housing starts are diverging from those permits with a pretty good amount, 1.446. I put this red line in here. That's kind of about the average. Historically, whenever we've fallen below this red line, we've gotten a pullback in lending, which impacted the inflation in the system, which resulted in a slowdown. This system historically has had plentiful energy, and we haven't had this stimulus money getting thrown around in the system. We haven't also had a shutdown in the economy for a couple of months or longer, depending on which country you are in the world, where it messes with supply chains. So we've got a system that we have not seen this in history. We are pulling back on housing starts, and historically, when this happens, we usually see a slowdown in the markets if this were to continue lower below this average red line. That is when we usually see a slowdown and a possible recession, or a deeper recession, the deeper it goes. The deeper this declines, the bigger the recession. Now, we have not overbuilt in this area here. We overbuilt here, we overbuilt here, we overbuilt here, we overbuilt here. Every single time in history, we have overbuilt in housing. We've had a hyper supply. Now, here's the thing. We don't have a hyper supply here. We do not have a hyper supply. And when you look back at history at these time frames, the hyper supply it happened in 2006 where this slowed down. It was a hyper supply here. It was a hyper supply here, and in between this. Or it's right here, sorry. We've had these hyper supplies, but we don't have a hyper supply. What we're seeing now is different than what we've seen, I think, in history. Because we've always overbuilt. And what I mean by overbuilt, if you look at the housing starts, we went up to 2.4 million housing starts. We went over 2 million housing starts. We went over 2 million housing starts. These all resulted in high inventories. They were all over 10 months of inventory at the top here. Now, here's the thing. We're heading lower in our housing starts, and our permits are still quite high. We've got a divergence between permits and housing starts that are happening. And here's the weird thing, though. Our active listing count, it is going up, but we are still at a very low level in relationship to history. Our inventories are still very low. And historically, when we see these types of rollovers in housing, we have been in an overbuilt scenario in all of these housing situations. We're not in an overbuilt scenario. We are very low on our inventories. This is an anomaly. And that's why I thought, and I still think, that housing is going to be very resilient because we don't have the inventory. So the median house prices are still not falling because the inventory is too low. But what I'm seeing is this average sales price for new houses dipping. That is an anomaly here. versus history. We have not seen it in these rollovers. We've always had excess inventory in these rollovers, but this is a new mix. And I think the rate of the increases of interest rates is causing this to roll over. There is an external factor that is driving this, which could be stimulus, or could be war, or a currency crisis, or something else. Historically, what happens is we get a large inventory of homes that would come way up here, like 2 or 3 million plus, and it would slow everything down, which means that the housing market is pacing our market. It's pacing the inflation. It is in control of the inflation. What we have now is it's either stimulus driven, or there's other means where we have to raise rates faster than what we think. An energy crisis per se. We've got the total listing count that looks pretty normal. We've got still very fast days on the market, and I expect this to come up. It will slow down and go to more normal levels. We also have a median listing price that went up last month at 16.6% year over year. House prices are not crashing, everyone. They're pretty much flat month over month. And even if this were to come down, it's come down almost every single time in this period because of seasonality. I don't think we're going to get a year over year decline. What we're first going to see are these guys they're basically going to put 2022 in here. Then we'll get 2023, and it will probably get a smaller gap between those price levels. The increase will be less. And this is the price reduced share. Houses coming on the market, they are reducing their prices. And basically what they're doing is they're guessing what the house could price, what the house could sell for. Then they reduce the price after they list the price. But it's still going for 16.6% year over year. They are still going up in price year over year. Now, we've got this energy crisis. And this energy crisis could push interest rates higher and actually, I think, diverge the markets from what we've seen in history. So what I'm saying is the markets that are coming could potentially not match what history has shown us. The energy crisis here is absolutely ridiculous. It is unsustainable, and it will be, I think, temporary for some period of time. This is the Dutch TTF natural gas price, and this thing is going ballistic, guys. It is way up there. The markets want more natural gas over there. It's also happening in UK. This is UK natural gas, and it is also rocketing higher. These prices are far greater than the Henry Hub natural gas prices, and I do think that they will converge over time. Henry Hub and these. Henry Hub is a lot more to go higher. These, I think, have some room to go lower to stabilize out. Now, we've got this producer price index. This is all commodities. It's coming on up, and we've seen a slowdown here recently. That is as expected. We've been doing strategic petroleum reserve releases. We've been trying to stop this move and slow it down. They have been successful at doing that in the short term. I don't think it's going to last for very long after the strategic petroleum reserve releases are done. I think this will continue to go higher. I think that these natural gas prices are going to get absorbed by Henry Hub to some extent, and I think that the PPI of all commodities will start to go higher again. We've seen that the crude gasoline distillate inventories are still drawing down through our inventories, irrespective of the strategic petroleum reserve releases. We can also see that there is, I'll call it unprecedented oil supply problems ahead of us if we don't have a lot more new investment coming in front of us that is required for a 30 million barrel per day supply gap by 2030. What could potentially happen is all of this stimulus money came into the system and basically pushed interest rates at a level faster than what it would normally have been from the loaning process in the real estate business cycle. This stimulus coming in pushes those interest rates up, and we could see a slowdown in housing. Now, I don't think it's going to necessarily be this blowout deflationary crash. I know everybody likes to jump to that. I think it will slow things down. We could very well pull back on a month-to-month type basis. But I don't think we're going to see some blowout crash. I don't think the loans in the system, there's not the rates have gone up very quickly. So a lot of people have very low rates, they have very affordable payments, and we've got very qualified buyers, qualified people that took loans out. So I don't think we've got those, we'll call it easy loans, unqualified people getting loans, and that they're all going to be underwater and they're all going to just walk away from the houses. I don't think that's the same scenario as 2006, 7, 8, 9, 10, all through that area. But we do have an energy crisis, and I don't know if we've ever seen this type of movement in energy prices before. I'm pretty sure it's going to have really bad ramifications to economies. For instance, I think that we will go into recession. The problem is, energy will also push inflation higher. And if inflation's high, we're going to see high interest rates because people don't want to hold on to bonds. They're going to be losing money. The CPI numbers will read very high. So if we have very high energy prices, this is a good setup for stagflation, which means that we have high inflation and a potential recession. I'll call it an inflationary recession. Now, I don't know if the housing market, if it were to soften, what that would necessarily do to inflation measured by the consumer price index. Because here's the disconnect. If you look at history, the real estate market has always driven this boom-bust cycle. And if you look at history, we've always had a surplus of energy somewhere in the world. This time around, it looks to be very much different. And I know Russia stopping their exporting of natural gas to other countries is going to have a large impact to this market and what it looks like. But that impact has created an energy crisis, which then shifts all of that money that's in the system, which is also stimulus money, which we haven't seen before. That could rotate into energy and commodities, which then gets seen in the consumer price index, which then puts pressure on interest rates to come on up, to be elevated. And that pressure from the energy crisis could push interest rates high enough where your real estate market can't sustain it. It can't sustain that high level of price. So it would be a different scenario than the 1970s even, because the crisis in energy could be large enough to push those rates to a level, the interest rates and mortgage rates, where we could see a weird scenario where we've got high interest rates and housing starting to come down. Because usually when housing comes down, interest rates come down with it. But right now I'm seeing energy and interest rates go up and house prices starting to level off. So we'll continue to monitor it. I'm not in the camp that we're just going to go straight to a crash in the housing market, guys. I know a lot of you, if I say, hey, look, we need to watch the housing starts because if they continue to decline, we could see a deeper recession. That doesn't mean that we are there yet. We have to see what that data is next month. We have to continue to see the data. The data is what shapes my opinion. I don't shape opinions without any data. That's called just guessing. And the markets don't move that fast, but we could see a lot of pressure from these energy prices, and they are going ballistic over in Europe. Electricity prices, natural gas prices, and then I think oil is going to go with it too. So that's what the current market conditions are. I just wanted to touch on that. If you guys like the content, give me a thumbs up. Subscribe to the channel. Subscribe to the website below, the Platinum membership. That is if you guys want to gain more further financial education. I also have a question and answer session on Sunday, 5 p.m. That's 8/21, August 21st, 5 p.m. Mountain Standard Time. You can ask me questions if you're a Platinum member on the website below. Just go ahead and sign up. There is a Zoom meeting call In fact, I can show you how to get to that. What you do is you open up, you go to finding-value.com. I'm already logged in as a platinum member. If you click on this little hand here after you sign up, these are everything in order. This is the log of all the posts on the website. You can log in there and you can see all of the posts. If you want to find something, you can see it. If you want to go to the Sunday Zoom Platinum meeting, that's this meeting here, Zoom question and answer session, Sunday at 5 p.m. Mountain Standard Time. You just click on this link and it'll bring you up to that meeting. So that is that. I've got a whole bunch of other things. These are in order, released from most recent to oldest. You can obviously see I've got question and answer session videos that are previous ones. You can talk. I do post some of the stuff that is on other channels that I'm participated in, some videos that the silver and platinum members can also see. And then I've got midweek updates for things that I think that look good at that time. So if you're interested in that, definitely sign up. It's in the description link below, the platinum membership. All right, guys, that's all I've got for today. Thanks for listening. This is Finding Value.